Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need.
Well, welcome everyone to the latest episode of the ASB Investment Podcast. On today's show, we welcome back a repeat guest, John Barrasso from First Sentier in Australia. Now, First Sentier specialise in the management of primarily fixed interest and fixed income assets. And ASB has appointed them to manage our New Zealand bonds and fixed interest assets and all of our wealth products. Now, we're talking to John today because of, amongst a regular check-in as such, but because recent global events have shined the light on the impact interest rates and their movements can have on investments such as bonds and fixed interest. Now, most of our listeners, you'll have an allocation to this asset class, whether you know it or you don't, in sort of diversified funds of assets or diversified funds. Now, most of them you'll recognise as either your basic investment fund or a KiwiSaver account. Or you may have directly owned them or still own them, bonds or other fixed income assets directly. Personally, I find it's an area that you have to constantly study to keep up with. And it's been an interest sort of, as counterintuitive as it sounds, an interest area of mine over the last sort of year. I think it's correlated with what's been happening with, central bank interest rates and official cash rates around the world. You just have to keep on top of it to see what's going on and basically why things are moving in the different directions that they do. So it's been about 8 months since we last had you on, John. We'll start off with, how are you?
Yeah, good, Nigel. Thanks for having me back, of course.
You're welcome. And anything interesting happening in where you're based?
It's certainly been a volatile period of time since we last spoke, so I look forward to this podcast.
And for those listening for the first time, didn't catch our last one with you, can you just give a bit of a background on yourself and also potentially what, First Sentier, a bit more background there?
Sure. By way of background, I have been one of the fixed income portfolio managers at First Sentier Investors for the past 8 years, and I've been looking after the ASB portfolios since I joined. Over my career, I've been investing in fixed income for the past 27 years now in various parts of the world, with my focus shifting to Kiwi and Aussie markets in 2006. Our team has managed the New Zealand fixed income funds for ASB for over 12 years now, so good track record. And these funds currently include 4 different products. There are 3 funds managed to a benchmark. 2 of those invest in New Zealand government bonds, one in nominal and the other in inflation-linked bonds. Then another fund that invests in highly rated corporate bonds like ASB, Auckland Airport, and Fonterra. And finally, the 4th fund is a more actively managed portfolio with similar investments to the corporate fund, but we add our active insights versus the benchmark to increase the return even further.
Sorry, that was my daughter. I had my daughter at the door there just for a second. So in case there's any background noise there, that's the beauty of live podcast recording at home. Right, we'll get back into this. So we're going to discuss today primarily your views on the evolution of interest rates and the impacts of movements we're seeing in them. So get out your crystal ball. It's only the question everyone wants to know everything about. Likely movements from here and what First Sentier are thinking about as a fund manager and managing and helping our customers grow their savings. But we'll also take a step back as well after that and do the 101 on bonds and fixed income again. I always think that's really important for investors, no matter where you are on the spectrum of knowledge, to remind yourself on how these things work, along with the things that are really important to keep in mind in this asset class during times like this and that we find ourselves in now. So first up, if we start with the macro, what's happening and why? This year has started fairly well, especially relative to the last year we had in 2022. So it's been generally positive. However, investors continue to experience volatility. And that's something, I think, to quote a cliche that's been used in the past, that seems to be the new normal for people. So if you're not used to volatility, you'd think you should be by now. So the first question I guess I'd like to ask and like some clarity on would be, what has changed since we last talked that 8 months ago? Like, what are the key things that stand out to you that have changed since that last conversation?
Sure. I mean, in hindsight, August of last year was a bit of a turning point. At the meeting in August, the RBNZ raised rates to 3%, which most central banks think is just above neutral. With inflation still on the rise, they had expected to raise rates further to near 4% at the time. Since then, employment and growth have remained resilient, and as such, inflation had proved stubborn. I think this fear of persistent inflation forced central banks around the world to move rates to much more restrictive levels, and New Zealand now sits at 5.25% as of today. Unfortunately, the same factors are at play that they were back in August. With employment still strong and high household savings rates, consumers have still been spending, really keeping inflation high. Now, it does appear that inflation had peaked at the end of last year, but really until the economy slows further and unfortunately employment worsens, there can't be certainty that inflation will continue to fall to levels that truthfully the central banks are comfortable with at the moment.
And you mentioned a couple of things there about particularly inflation. That seems to be the one that everyone has top of mind. What I've sensed in the last couple of weeks is now, especially in the US, employment starts to be creeping through as kind of one of the key or keyer, to use a made-up word, things. What would be one of the top things or key couple of things that you're watching to help work out where we are going next?
Yeah, I mean, we always have to remember that a lot of the core data points have quite large lags to them. So unfortunately, the central banks aren't going to really know how inflation is tracking until, 1.5 to 2 months after the quarter's ended. Jobs data is also on lags. So really what we look at, the last few quarters have seen inflation come off the peaks from last year, but are still high compared to where the RBNZ hopes to get it. Unfortunately, things that will slow down the economy, as we talked about, have lags. So what we're watching is business and consumer surveys. ANZ and other banks put these types of surveys into the street, and they give you more of a real-time sentiment to understand if that sentiment is actually worsening. Within these surveys, we can see what they think on future demand, employment, and most importantly, I guess, inflation expectations. We're also looking at job posting data, what's out there at the moment, and certainly announcements from large companies on any potential employment changes. And to your point, we're kind of seeing this out of the U.S. with some of the larger institutions cutting significant portions of their workforce. So this is some of the more real up-to-date information that we're just tracking to make sure that unfortunately we do see that steepened decline in employment and the economy so that the RBNZ can achieve their inflation target.
And if we think back to sort of how rates work in conjunction with those things, where do you, how would you describe how they've evolved over the last 8 to 10 months? Some people say it was, the fastest hiking cycle in recent memory. How would you describe how things have evolved over that period?
Yeah, I do think it's been a wild ride, and to better understand it, I think it is important to step back and look at the recent evolution of rates. The RBNZ, like all central banks, are usually mandated to promote two things. Keeping the price of bread and other products from rising by more than roughly, let's say, 2.5% per year, or inflation. And the other is making sure as many people as possible have jobs. Central banks use monetary tools, monetary policy to balance these two goals. And they usually feel that interest rates around 2.5% should balance these two factors. And that's what's considered neutral. To help create jobs, the RBNZ would usually lower rates below 2.5%. And when it needs to bring down inflation, they move it above 2.5%. So now with COVID, understandably, the worst was expected for employment, and rates were moved to near zero, in the hopes to encourage consumers and businesses to borrow and grow and hire and spend. Fortunately, the worst didn't eventuate. and employment and growth ended up being very strong. 18 months ago, the RBNZ started to return rates to 2.5%. But as they approached this level, roughly around the time we were talking last, they realized that employment and growth were now so strong that demand had driven inflation to over 7%. So by a natural reaction function to counter this, the RBNZ just kept going. And obviously has now moved rates to 5.25% in the hopes that this will realign the two factors over time.
Okay, so we know that the rates have had an impact on a number of things. One of the things and how this rate cycle has progressed as such in the recent month or so has impacted one sector or area in particular, and that is the global banking sector. So can you just, because there's been a lot of talk about this, can you just give your view on, what impact that has had on, regional banks, some call them as such in terms of, particularly the ones that have been affected in the US or the global sector in particular?
Yeah, sure. I mean, regarding the recent headlines around SVB and Credit Suisse, I genuinely think it's really been a story of poor risk management and the public's falling confidence in these companies. Let's start with SVB. It was a mid-sized bank in the U.S. That didn't manage their balance sheet well. So what they did is they took in on-demand deposits, primarily from Silicon Valley startups, and then they took those funds and bought long-dated bonds. Of course, dear to my heart, but again, not very good with the balance sheet mismatch. So as interest rate rose, the value of those bonds fell. At the same time, with higher rates and a slowing U.S. economy, those same startups needed more cash to cover costs. And what they did is they started to withdraw more of their deposits. So SVB was forced to sell their bonds at a loss. And unfortunately, as with most public companies, this bad management became public. It cascaded into a complete lack of confidence and a run on deposits, and leaving SVB with a large loss on the bonds it simply couldn't cover. So unfortunately, that saw the demise of them. Unfortunately, this was bad timing for Credit Suisse. So separately, they had been plagued by various losses from scandals going back the past 3 years, really. And when Credit Suisse was forced to delay their financial reporting for 2022, after the SEC started looking into irregularities around the same time as SVB, this led to a complete loss of confidence in the company and the forced sale to UBS. Now, with events like this, there's always the fear that this could cascade to other institutions that are more sound. So obviously this kicked off a period of risk aversion in all markets, which we experienced over the month of March. I would say, fortunately, government agencies were pretty quick to intervene, offering excess liquidity to the sound institutions. And fortunately, this did eventually settle the markets to where we are now.
And with that and what we've talked about in terms of where rates have gone sort of over that 8 to 10 month period, how does that impact investors in the funds like you help us with at ASB?
Yeah, historically, over a 3 to 5 year time frame, fixed income has been a great diversifier to risk assets like equities, and it's important to a balanced portfolio. The recent inflation shock and aggressive rise in rates has challenged that dynamic in the short term. But again, we always like to look at things over a longer time frame, 3 to 5 years. But what I would say is the recent price action after the concern of Credit Suisse and SVB does show that this correlation still holds true. So as these events unfolded over the month of March, we talk about this risk aversion, contagion concerns. The government bond fund that we look after returns 2.3% in the month alone. So again, over the long term, in times of stress, fixed income and government bonds become a safe haven for investors and help drive bond prices higher. So very reassuring that after this period of raising rates and higher inflation, that we do see a period of this where bonds kick back into their natural diversifier in risk aversion.
And we talked a little bit about some of the drivers behind some of those issues. But with regard to central banks in particular, do you think, and this will be kind of the last thing to press on in this section here, but do you think they've gone too far or not enough?
Most central banks around the world would feel, I'd say, that they are close to the end of their hiking cycle. They may think that they need to go a little bit higher, but then it becomes a question of how long they hold it at these high levels before they can go back to neutral. So what we've seen over the past month at their most recent meetings, the RB&Z, the ECB, the Fed, they all looked past the recent volatility and went ahead and increased rates further. Now, this was still in line with the forecasts they expected before the volatility of March. So I guess they simply held their ground in this instance. Maybe the one outlier is the RBA, on the other hand, has taken a wait and see approach, being the first major bank to actually pause. But do keep in mind that the RBA is the one institution that almost has monthly meetings. So they have more frequent opportunities to adjust pricing compared to some of the other banks. Now, most central banks and market forecasters for that don't expect inflation to get back to neutral until 2024, maybe even to 2025 in some of these forecasts. So I guess to answer the question, it would be hard to argue that central banks have gone too far in raising rates to this stage. And I always say, history has proven that if you don't stomp out inflation the first time, it takes double the effort to do it the second time around. And this goes back to the U.S. and Volcker and Burns, two central bankers in the U.S. that treated inflation very differently. Burns goes down as the guy who started cutting rates too soon, and Volcker's the champion that fought inflation. So I think now is the question is how long central banks will hold rates here before they return to neutral. And of course, I always say this, it'll be easy to criticize them in hindsight, but that's why it's hindsight. We have to remember, this is the highest rates have been since 2008. And the clear feed through to consumers will continue to be felt as mortgages resets and consumers roll off their really low fixed rate mortgages. There was a massive overhang of demand after COVID. People wanted to travel, myself included. They wanted to eat out, shop, and consumers had also built up a large savings pool around COVID because, to be fair, most people were able to keep their jobs. So hopefully as this incredible demand slows, increase of costs do start to bite, mortgage rates, cost increases, businesses will react to this, and we will see continued slowing of both growth and employment. Unfortunately, I think that central banks will want to keep rates elevated until they see clear signs of inflation is returning to normal. So this could mean that New Zealand's cash rates, at 5.5% really through most of this year, before the RB&Z can start to return it to neutral sometime next year.
I guess the one final comment I would make be the more raises you can get in allows you then more room to ease, correct?
Absolutely. I'm happy to talk about that a bit later, but it's very much the larger the bandwidth of potential opportunities, and we've talked about it in this podcast before, the greater the option of outcomes in both economics and inflation occur, and that creates volatility.
Yeah, and before we move to the next section, at central banking school or university, you raise that good point, but I've heard numerous times you don't want to be tagged as the Arthur Burns type central banker. It's more the Paul Volcker one, even if you don't have to go to the extent that they did.
Correct. And I'm very sure that every central bank chair's consciousness is reflective of how they want to be perceived in the future.
All right, so into our second section, let's look at a bit more in terms of sort of start out with the 101, but a bit more of the investment fundamentals and what we've talked about already, how that actually feeds into maybe what is part of your portfolio, or some questions you've got in terms of how it impacts you as such. So, John, if you're able to give us a bit of a short 101 on bonds again. Now, a lot of listeners, you might already think, I know all this already. However, it's good. You're never too old to brush up on the fundamentals. So just a short 101 on maybe bonds, different types, and particularly what stood out was, whether you want to reference this or not, was, when SVB had to sell those bonds at a loss, even though if they'd held them to duration, they would have been fine. But just a short 101 and some key things that you think are, important to keep top of mind when thinking about bonds and fixed income.
Yeah, I certainly like having people interested in fixed income, so I try to keep things as simple as possible. So probably a quick bond 101 is that all fixed income products pay a fixed interest rate. So that fixed interest rate becomes more attractive if interest rates fall. So as interest rates fall, you have a set fixed interest that bond is paying. What's going to happen is you're going to be driving up demand and the price of the bond. Conversely, if interest rates rise, investors will no longer prefer the lower fixed interest rate paid to buy their bond, resulting in a decline in price. So that's kind of the dynamic, obviously, where interest rates go up. Obviously, everyone wants to buy the new bond that has a higher coupon, and they sell their existing ones. Hence, the price dynamics of rates up, bond prices down, or rates down, bond prices up. So over the past year, the funds have had a negative experience, obviously, as interest rates have risen and the price of bonds has fallen. Now, New Zealand inflation bonds are slightly different in that they have a fixed coupon, like normal bonds, nominal bonds. But what happens is the notional of the bond increases as inflation increases. So what we're saying here is, although initially as rates rise, just like any fixed instrument, the price of the bond will fall. But what happens is if inflation increases by, say, 7%, and the coupon on this bond is 2.5%, then what's going to happen is you will get a 2.5% coupon on a notional amount that is 7% larger than the last time your coupon was paid. So that's the big dynamic change and helpful factor of inflation-linked bonds. So again, if inflation increases by 7%, which is quite large, obviously, not standard, between the two periods where a coupon was paid, then your notional will increase by 7%. So in a sense, helping offset some of that price loss in other products. So again, what that means is in periods where inflation remains elevated, which might be the case in this scenario throughout the rest of the year, maybe if it's next year, but inflation is expected to normalize. And this is always key for central banks. They always look at inflation expectations. And right now, inflation expectations are still anchored. And I always say a good example of that is in Argentina, they are facing 100% inflation. Unbelievable. You couldn't imagine it. But if you ask the average person on the street, they would tell you they think normal inflation is about 20 to 30%. So again, what we see there is that inflation expectations become unanchored, and that allows inflation to remain elevated. So that's why inflation expectations are key in developed markets. And fortunately, right now, New Zealand still feels confident that inflation expectations remain anchored. And that's why these inflation-linked bonds, for this period of time, at least over the next, year or so, where inflation may remain elevated, the cash flow return remains large and positive for these types of securities.
And is there any, just to laser in on that a little bit, is there any environment where inflation-linked bonds, it's not good for them? I heard someone say that if inflation keeps rising, or maybe was it rates keep rising, then that's not a great environment, but...
Yeah, and again, so their prime time is obviously when inflation is elevated for a period of time, but inflation expectations are moderated. So let's say you have a 10-year inflation-linked bond. You're buying the bond, in a sense, at a yield where the market thinks the average inflation will be over the 10 years. So let's say we think inflation over the next 10 years is going to be neutral, 2.5%. You're going to buy the bond expecting 2.5% every year. So when you have periods of inflation at 7%, but you were able to buy the bond at 2.5%, then obviously for that period of time, you're going to be on a positive cash flow. Your notion will increase by 7%, but in a sense, you only paid 2.5% for the average. So again, the key there is that you would want the average of increases to be higher than 2.5%, which is what you expected when you bought the bond. Now, there have been rare instances like around COVID where we actually experienced slight negative inflation. In that scenario, you could see the outcome. But in most cases where rates are rising, but inflation expectations are stable, the bonds will be beneficial for fixed income products.
I guess you can probably be guilty of over-analysis sometimes, But, I guess if inflation is rising or elevated, inflation-linked bonds sound like the way to go.
They are a better outcome in bad scenarios for a fixed income product. So they do have that bit of protection that still continues to give you income with some protection on the top side during inflation periods.
Okay, well, so from inflation-linked bonds, which is something I always try and keep brushing up on, so thank you for that. But in terms of giving the audience a bit of a latest update on any sort of, investment decisions made, anything you're keeping an eye on in particular since we last talked or to start this year, anything stand out to you?
So, I guess it's always important to see how we manage the ASB funds in volatile times like this. And unfortunately, we've experienced a couple of them recently, particularly going back to March 2020 with COVID hit. Obviously, there's a number of factors that you have to take into account and be aware of. I guess I would round it out by saying New Zealand is a relatively small developed market. What this means is that unlike the U.S. equity market, which is very deep and very liquid, New Zealand fixed income always needs to be carefully managed. We have a saying that there is nothing passive about managing a passive New Zealand fund. And I know you may laugh at that, but it is a reality. One of the reasons we were chosen to manage these funds is our deep credit research team and our ability to make active decisions. So with the market size of the ASB funds invested, every decision, even in passive funds, needs to be carefully considered. And ASB has given us the ability within the mandates to do that. Let's say an example, when a new bond is issued by a New Zealand corporate, let's say Fonterra comes out in the middle of the month or the beginning of the month, we may choose to buy it at that time if we like the credit, we like the current environment of overall credit, rather than wait until the benchmark adds it at the month end. We feel making these kind of decisions adds the most value to ASB customers in a market like New Zealand, rather than just setting the fund's actions on autopilot, like a lot of passive fund managers do. Now, where we do have more discretion, particularly like with the active fund, we're really looking at big macro events. Obviously, one of the biggest being the recent rise in rates. We did feel confident that was coming in 2021. We took the portfolio underweight the interest rate of the benchmark. And now what that means is, although the fund still experienced a negative return as rates rose, it was better than what the benchmark or passive funds would have experienced. This approach played a significant part in the positive active value we delivered for the funds in 2021 as rates started to rise. So, the focus of the ASB funds is obviously on performance, but of high importance at all times is also on capital preservation and available liquidity. And that's really important in times of March 2020, GFC style events. So again, it's keeping those three factors well aligned when you're trying to make these smaller micro decisions, and obviously the bigger ones on the more active fund we manage.
I like in your intro to that point that, there's even an index sort of managed mandate as such. There's still, I think people sometimes underestimate the amount of work that goes in there, particularly if you're scrutinizing credit worthiness and who's actually issuing as such, correct?
Yes. And again, it's a factor of a small market, and typically markets are smaller. They are less deep. And you just need to manage them differently because there's still a significant amount of money invested in these markets. You just need to be more thoughtful on how you manage the process.
And then we had you on, when we had you on last time, you made a really good point about stepping back and seeing what bonds have done, over the past few or, several many years, not months. I know a lot of investors have, quite rightly been focused on that last 12 months and what they've seen. What are the key things there that either you still have top of mind or you now believe, even more so than you did before?
Yeah, I mean, I think I would always say the standard sales pitch for fixed income is it's a part of a balanced portfolio because over a 3 to 5 year time frame, it is offered an income stream, obviously, for investors. And history has shown it as a great diversifier to risk assets like equities when risk aversion does occur. There is no doubt that being a fixed income investor over the past year has been difficult. Inflation isn't something this generation has experienced in any real form. You need to go back to 1990 to see the high that we experienced this year. Any rise in interest rates erodes some of the value from fixed income products. And considering that we started 18 months ago with rates at almost zero, the impact was meaningful. We're aware of that. Looking at where we stand now, current yields on fixed income portfolios are very high by historical measures. The corporate portfolio that we manage is now yielding over 5.5%. If you are near retirement age, this is the highest return a bond portfolio has yielded since 2008. So assuming we are nearing the peak of the rate cycle, as most central banks predict, then you also bring in the potential for capital appreciation. As rates return to neutral, it is a strong possibility that this also occurs. Again, the goal of the central bank is not to maintain 5.5% rates indefinitely. They want the balance to occur, which means at some stage you're bringing rates down to 2.5% or lower if things go bad. So again, when you're looking at that band of potential outcomes, it's difficult to see a scenario where central banks can go much higher than where we are now, but you open up the potential of seeing them go back to zero. So again, when you look at where we're at now, what the product offers, those are certainly some things we need to consider, and also, I guess, as we saw last month, over longer periods of time, fixed income will help diversify a portfolio if markets are stressed. And I think that's important to remember because it's been hard to see over the past year.
One thing I was reflecting on this morning as I was eating my toast, as one does just before they start work, like if you ask probably the average person right now on their view on bonds or fixed income, you might quite commonly get a response that was something to the effect of, they're quite, based on the last year I've had, I see them as quite risky. But if you'd asked them 12 months or 15 months ago, when you think about maybe an average bond, yielding close to zero, 0 or 1, they wouldn't have called them maybe risky then, despite the fact that if you invert it, they're extremely highly valued. So it's quite that's why I think it's so important to keep an eye on fixed incomes. It's quite a counterintuitive thing to think of, and how you've just described it. But actually, there's great yield there now and the chance to get some capital growth.
Yep. And I think probably when we spoke in August, I could still make this statement, but obviously prior to that, it was a certainty. If you looked at longer returns for your bond portfolios of, let's say, 5 years prior to this move, you were looking at between 5 to 7% annualized in some instances. Now, again, one component is always your income stream. And when rates are at zero, it's hard because these coupon payments are very low. But again, from that capital appreciation point of view, which is another component of fixed income, obviously rates had moved to 5% or so 2008 down to zero, which resulted in a significant capital appreciation gain in your fixed income portfolios. Now, again, that's obviously been wiped out because we're returning to levels we haven't seen in 15 years. But again, on a historical basis, let's look at that as if it resets. Again, your coupon stream, as we talked about, is very positive right now. Historically, it's one of the highest we've seen in a while. And at the same time, there is some likelihood that that capital appreciation component will kick back in. And again, normalizing expected returns on a bond portfolio over a 5-year period. So always important to think about it that way. I know in the moment is what you remember, but certainly over the time frame is how we look to present the product.
All right, so let's crack into the final section, and I'm sure it's a question everyone is always asking. Where to from here? Get the crystal ball out. What's the path for rates? What does the future hold as such? So, our ASB economists think that we're nearing the end, as you were saying, John, for a lot of the major central banks. Whether it's a line call from a few in terms of whether they hike again or keep on hold as such. Where do you think, I guess, what would be your major pick or anything you want to call here in terms of where things are going from a central bank perspective?
Yeah, I think I've hinted to it a bit throughout the podcast. I don't feel the conversation from central banks will be how much higher they need to raise rates, but rather how long they hold rates here. So the 1970s and 1980s had proven that you need to be sure you have lowered inflation before you adjust rates lower. Again, going back to the Burns-Volcker debate. If you're proven wrong and need to raise rates again, it is required even higher rates and hence more damage to the economy and employment the second time you try to tackle it. So I think that is front of mind for every central banker right now. I think rates could remain at these elevated levels for most of the year because it is important to the central bankers right now, where probably the RBNZ will have more comfort that they're on the right path at that stage. One thing that could derail that is a significant fall in the economy or employment, but that's not forecast or likely at this stage. So then maybe the next year you would see rates slowly return to neutral or roughly 2.5%. Unfortunately, the RBNZ expects to see a marked worsening of the economy and employment to slow demand and inflation. That's the thing they need to have happen for inflation to come down. Not an ideal scenario, but that's what they need. I don't think we will see a deep recession, but I do feel we will have a number of quarters of negative growth and hence an increase in the unemployment rate, which, to be fair, the RBNZ is forecasting.
As you were mentioning some of those things that they're looking for, I get a parental vibe, in terms of you might, this is the best thing for you in the long run as you grow up. You may not like me in the interim, but it's kind of like this is the path this is the medicine.
The RBNZ Bank and Governor Orr take a somewhat more casual approach to things where they are more open, saying, for me to fix A, I need B to happen. And unfortunately, B is a worsening economy and a rise in unemployment.
And I guess, as I often use the phrase, if Fed Chair Powell says the wrong thing, markets move all over the place, where I'd say if Governor Orr says something, it's probably less infectious, for lack of a better word.
It affects domestically, does not move outside of this landmass.
Yeah. So just to find a couple of points, are there any good news stories investors should be heartened by? I know we've talked about, yield is back. Inflation feels like it's getting under control, albeit still a little bit high. What would you say is the to look through the gloom as such, what would be wise for them to keep top of mind?
Yeah, I like the fact that we've gone almost 6 months where inflation has peaked. So that is the positive. It's not falling as much as they would like, but I do think that was an overhang of the demand and the savings rate that consumers had, and that's going to move through the market. Domestically, there's certainly that cliff of the mortgage cost scenario. So I do think that things are in place at the moment to bring that demand down and, as a result, force inflation lower. It is a longer period of time, but absolutely something that's going to happen. If that's the outcome, then as we've talked about, entering fixed income now, you're looking at historically high coupon yields. So again, that's income coming into an investor at the given time. You're also open to the potential of large gap in capital appreciation, which obviously we experienced negatively on the way up, but likely partially to retrace or in some scenarios, fully retrace. So again, looking at it from an income point of view, looking at it from a capital appreciation point of view, and as we talked about in March, looking at it from the diversifier in risk aversion scenarios, it looks like in that scenario, it will continue to hold true. So again, on the main points that we always introduce fixed income as, we are at a better point to talk about those points as a positive than maybe we had been over the past 5 years.
And that strikes me as something very important to keep top of mind from a yield perspective, better than it was. There is now more upside for you to benefit. But as part of a diversified portfolios, if markets, what we've talked about stays true and markets do their thing, investors should benefit.
Correct.
So one of the key things I think to wrap up that our audience and investors should keep in mind, I think apart from doing more study and learning like I am on fixed income, I find it a very fascinating topic, would just be to get advice and guidance. So if you have any questions about your own investments, just talk to an advisor if you have one, or seek advice out. It's the critical thing that can help you stay true to your goal and time frame and keep you on track to the outcome you went originally into the investment you're in. All right, so to wrap up, is one key question that we're asking our wonderful guests now more and more. John, would be, what are you reading or listening to currently? And again, it doesn't have to be investment related. Something that is a curious focus for you that you think our listeners might also like to partake in.
No, I like this question, and would likely my answer would embarrass my teenage boys. But coming out of university, I said to myself that if this finance thing didn't work out, I would go back to school and be an astronomer. I don't think that's at risk anymore, fortunately, but still love the area and make many of the NASA podcasts a first stop for the commute to work. I would say with the launch of the James Webb Telescope recently, there are some amazing discoveries we will see over the next few years, and keeps a dork like myself very interested in the topic.
The parallels between some of the work that NASA does and long-term investing strike me as very, very aligned there. Is that fair?
It takes a special creature to do both.
All right. Thank you, John. We'll wrap up there. It's been a pleasure having you back and to see you again. To our audience, again, if you have any questions like this, seek advice. It's the most powerful thing you can do. But until next time, we'll see you again on the ASB Investment Podcast.
Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, get in touch at podcasts@asb.co.nz.